Hi, everybody. Chantal DeYoe with Chantal's Bookkeeping here, back for our third session on the chart of accounts. I want to talk about something very specific with you today, and it is the credit card. And it's so interesting to me because when I was young and naive, I'm neither young nor naive anymore. Okay, let's not go there. Anyway, when I was young in my work as a bookkeeper and was still trying to wrap my head around all this stuff, I really struggled with this. But as I got better at what I was doing and learned the parts of the chart of accounts better, I really came to be fascinated with how this all works together. So let's say the sample company has a MasterCard here. All right. So let's say that you go to the grocery store and you hand your card to the clerk and she runs your card and you have paid $100 for your groceries. Now you spent that money you spend. What is that in the chart of accounts? We've talked about that, haven't we? That is an expense. However, you put it on a credit card, which we learned in earlier videos is a what? It's a liability. It's money that you owe. So that $100 that you spend at the grocery store in your books is at the same time an expense and a liability. It's an expense because you bought groceries and maybe you've got a groceries expense account and you put it in there. But it's also a liability because you haven't actually paid it yet. All you did was you put it in this holding spot, this credit card saying, I'm going to pay that later, but I'm going to take ownership of these groceries right now. Okay. So you spent money and you gained the groceries, but no money has actually gone out of your checking account. Like you haven't reduced the ownership of that cash in order to get those groceries. You just put it on a credit card and made it money that you owe down the road. It's kind of fascinating because it's at the same time an expense and a liability. And when this is decades ago, but when I was, trying to wrap my head around those two things and how they work together, um, I really it really took me a while. And once I finally, got it in my head, I was like, oh, that's cool. It makes a lot more sense. And it leads right into the whole idea of the different reports that we talk about. Most people can understand an income statement. I want to look at how much money I brought into my business or how much money I brought home from my job and expenses. I want to see how much money my business has spent or how much I personally have spent. And am I doing well? Am I bringing in more than I'm sending out? That's the big question we all have, right? But it also relates to something called the balance sheet, which all of us are kind of like, okay, that's where I start to get a little nervous because I don't really understand what that means. We're going to talk about that in another video, what that balance sheet means, but I'm going to give you a little hint. It has to do with these things called liabilities and assets and even this equity section that we're kind of like, I really don't get what that one is. But that's what the balance sheet is about. It's going to track things like this right here. And then if you want to go even a step further, which we're not going to right this second, but when we're talking about cash flow, and that was what was really confusing me as a youngster, was the difference between expenses and liabilities with a credit card because of cash flow. It's like, well, I've spent this money, but I haven't given the money out of my hands. And so, and once I finally started understanding that whole concept of cash flow, it started to really kind of resonate for me. And I hope I haven't confused you with all those terms. My goal is to simplify. And right now, the takeaway I want you to have is that when you use a credit card, you are spending money, but you're also incurring a liability. You're also increasing what you owe because you haven't actually paid it yet. All right. Join me again for another time. Thank you. Bye.